Mic check 1 2 3. Good morning, everyone. Ankit this side.
Good morning, Ankit ji.
Hi, good morning, Ankit.
Sir, shall I start the session?
Yeah, please go ahead.
Good morning and namaskar to all connected to this webinar. Respected Mr. Santosh sir, speaker of today's webinar, S.B. Sharma sir, DJFRU chairman, Mrs. Sarita Singh, CEO, participating valuation professionals, and my colleagues. I, Kajal Gupta, manager of DJFRU and coordinator of this webinar, extend a warm welcome to you all. It has been our endeavor to conduct CPs on subjects which are useful to the participants in their professional practice and which sharpen their skills and improve their knowledge. The subject of this webinar is how to calculate A's and B's, that is alpha and beta of valuation. We are sure that participants will be able to fully understand the concept involved in the calculation of A's and B's. Taking us to our subject is esteemed speaker Mr. Santosh Dev. He is a chartered accountant and a registered valuer for asset class securities and financial assets. He is advising multiple startups on various issues, including finance, compliance, and fundraising. He is a weight speaker and is a regular speaker at SIRC of ICI, the Institute of Analytics, USA, and various RVUs. He has working experience with industries as an executive and also as a professional. I am sure you all have a pleasant learning experience. So over to you, Santosh sir. Thank you.
Thank you so much. So, good morning, everyone. I am Santosh. Thank you for the brief introduction, madam. So, on the onset, I would like to thank Ms. Pavitra, my partner, for helping me with preparation of this particular material. Mr. Balaji, who is again a colleague of mine who helped me in preparing the presentation. And I would like to thank Divya Jyoti Foundation for giving me an opportunity to talk on this particular forum. And thank you all for attending this session. So now, this session, let me set up the expectations, what we are going to see and how we are going to proceed with this. So today's session, we will be looking at how to calculate predominantly the unsystematic, systematic risk-related data, the betas and alpha. The beta, how do you calculate beta? What is a better way to calculate beta? How do we usually do? How can we refine beta to get a better value estimation? So this is something that we will be covering. So in the previous sessions, I was told that I go a little fast, so I'm trying to slow it down a little bit. If you find it to be fast, even then you can stop me then and there. Let us make this an interactive session. Probably a few questions from your end throughout the session. If you can raise your hands, probably someone from DJF can allow you to talk also. We'll try to keep it interactive. If you have a doubt, please stop me then and there. We will address that particular doubt on the session, and then we'll move forward. That is what we are planning to do. Then this particular session, we'll divide it into two parts fundamentally. One is the PowerPoint presentation, the theory aspects of it, how beta and alpha, what is alpha and beta, and the next part would be the practical, a little bit on how usually the fund houses and other forums which usually give you the beta, how do they calculate beta. You'll have to know that a little bit, because whenever we are using the beta number that is being given, risk premium that is being given, we take it for granted. We take whatever number is given and we directly use it in our valuations. So that might not be the right thing to do. So and fundamental understanding of how they calculate beta would be of a little bit of a help. So, and I also plan to learn a lot from this particular session. So we'll make this a little interactive. So let's start with the session with the presentation. We'll go about a little bit on so this I think anyone who has attended, they will automatically take note of it, not required to put it on the chat box. If you have any doubts, please you can set it up on the chat box. The names and the numbers, I think it is, or they have already automatically captured it. Once you click on the link, they automatically capture it. I don't think it is required to be again posted on the chat box. So let us start. The starting, we will be looking at a broad-based idea of the basics of why beta and alpha are coming through, and then slowly we'll go there. Sir, there's no need for the IBBA numbers here in the chat box. They will capture it from your links. So now, valuation approaches, we know. I'm going to repeat a few things that I've taken in the previous few sessions. Valuation approaches, we all know there are three major valuation approaches recommended by the international valuation standards, and predominantly that is being generally followed also. So the first being your market approach, then comes your income approach, then comes your cost approach. The market approach provides an indication of value by comparing the assets with identical or comparable assets for which the market information is available. This is supposed to be the best method that is available in the market for doing a valuation, because this takes the maximum market observable information. I have one phone in my hand. I want to know how much this phone is worth. I'm going to the market. I'm finding out how much a similar phone is costing in the market, and I'm going to price this particular phone with comparing that particular phone. So that is about it. That is the market approach. Next comes the income approach. Income approach comes a little down in the stairs because it also takes up market information, just like your beta, risk premium, and the risk-free rate. But it takes some information about from which is generated by the company. They're going to give you information about the company, which the future projections of the company, which is an internally generated information. Sir, I would request to, how do we stop this chats from popping up? I don't know, because it comes in the middle of the screen. Okay, nevertheless, let's move forward. This is the second approach, the income approach. Then finally, we come to the cost approach, where very minimal information on market observable information inputs is taken for making an assumption or making an evaluation. This is with regard to the cost approach. When you look at cost approach, the approach provides an indication by calculating the current replacement or reproduction cost of an asset. This replacement and reproduction cost, probably we are taking some amount of market information, but that particular information might not be the it is not used to the perfect extent to find out the value. Now let us move on to income approach. When do we use income approach? Income approach is used based on two questions. The income producing ability of the asset is the critical element of affecting the value of the particular asset. That particular asset that you are going to value should first produce an income. So now you have a painting that is there, which is not going to produce any revenue. It is not going to produce any income. Let us say, unless otherwise someone buys it out, capital gains is going to happen in the future, which will again depend on the future market value of this particular asset. Unless otherwise that happens, I don't think there is any value that is going to be revenue that is going to flow into your hands because of you holding that particular asset. Then that particular kind of asset cannot be valued using the income approach. You can take the future market value, say that there is going to be a capital gain, that is an income. But then if you are able to calculate what is the market value of the particular asset in the future, you can very well calculate what is the market value of the same asset today. So that differential, if you are able to do that later, you will be able to do it today. Better go with the market approach. So that kind of assets cannot be valued using the income approach. So it needs to be an income producing asset, and not only just an income producing asset, it should be the one of the critical elements. It is not that it also I have Mona Lisa's painting, I can put it in a museum and it might get a few walk-ins. Because of that, I will get some ticket revenue. I will get some ticket revenue from this particular painting, and based on this, I'm going to make some income. Whether that income is going to be the primary source of income, no. The Mona Lisa's painting is more valuable on itself rather than the income it is going to generate. It might not have the critical element. It is not a critical element to do the valuation of that particular asset. Now, apart from it being a critical asset, though it is a critical income being the critical element in valuing this asset, we need to know a reliable estimate, reliable projection of what and when the income is going to come. What income is going to come and when it is going to come, we should be able to know. If I'm saying 1 year from now, I'm going to get 100 rupees, I should be able to make a reliable estimate, at least 90 to 110 it should be. It should not be very unreliable. It should not be an assumption, just an assumption. So that is something that needs to be very clear when we are going to choose an income.
Very important.
Sorry, sir, I did not get your point. Can you repeat, sir? I did not know who spoke.
No, I think he spoke by mistake.
Oh, okay. So let's move on. So these two are the major tenets that you need to check. You can assume when you're choosing an approach for doing a valuation, it is as if you're sitting on a panel, an interview panel. You will ask multiple questions. You will make ask questions regarding one, the nature of the method in itself or the approach in itself. You will make an you will be there is one another thing that you'll have to see. What are the information that is available about the asset? What is the market for this particular asset? What are the market available information? All these things on all these characteristics, you will be asking questions. And for income approach, these are the two questions based on these characteristics you will be asking. Let us move on. So income approach, other circumstances, when though income approach is not to be used, it is disqualified because of the other two methods, the other two questions that were there in the previous slide. When else can we use it? Not though it cannot be used as a primary source, as an additional source, as a verification source. The income producing ability of the asset is only one of the several factors affecting value of a market participant perspective. If income is not the only source, it is not the most critical source, but it is one of the source, then still you can use the income approach. You can do it for two reasons. One, you can do the market method, you can do the income method. You can give a market method a higher weightage, and income method you can give a lower weightage, and you can do a weighted average and you can find out the value. This is one way of doing it. The second way of doing it is finding out what is the value as per market method, or finding out what is the value as per cost method, and then doing an income approach based valuation, and then finding out what is the value. And this value you can make an comparison with the market approach or the cost approach, and trying to match it, trying to understand whether this particular value that you're getting from market approach or cost approach is a little significant, or is there a huge variation? If there is going to be a huge variation between these two, then you'll have to go back to the drawing table, find out, though it is not critical, if income is one part of this particular asset's value, why am I still getting a huge variation? You'll have to go back to the drawing table and think about it. There is significant uncertainty regarding the amount and timing of the future income. If that is there, again, you cannot use it as a primary source, but then you'll have to again use it as a secondary source to make a verification. There is a lack of access to information related to the subject asset. For example, a minority owner, he might not have all the information that is available to the guy, to the chairman of the particular company. So that might be there. The subject asset has not yet begun generating income. Your startups, in the case of your startups, most of the startups will not make money for a longer duration. So Amazon did not make money for almost 10 years. Facebook did not make money for 5 years. So all that being there, still that income earning capacity itself is not there, but still income approach can be used, provided if you go into the future, you take a longer period of projection, and then you go ahead and do the valuation. So this is with regard to income approach. This is just a overview of, okay, one more slide is there on the overview. We'll finish the overview and then we'll dive into alphas and betas. A fundamental basis for the income approach is that investors expect a return, receive a return on their investments, and such a return should reflect the perceived level of risk in the investment. Yes. See, if you are making an investment in a particular asset, the fundamental assumption is that for my risk, for an individual, their level of risk that I am considering, I should be able to get a return. We all know as risks go by, the return also goes up. So when I'm taking a risk in a particular investment in a particular asset, and I think the level of risk is high, then the return also, I would be expecting the return that I am expecting will also keep going up. So that level needs to be maintained in the income approach. But there is a problem there. The problem is that in the income approach, what we are calculating is only the undiversifiable or systemic risk. The risk that is available in the market, which is undiversifiable because it is already diversified, it cannot be diversified any further, and then the amount of risk which is it is inherent in the system, that risk, that return is what you will be able to estimate using the income approach. You will not be able to. So example, I take a risk in that particular asset. I am taking a minority share in that particular asset. Probably because I'm taking a minority share, I am taking a risk. I'm investing in a private company, I am taking a risk. These kind of external factors or other factors that are not there in the market, if I'm taking that particular risk, that risk is not compensated using the income approach. You can do it using a premium, using a discount, but that does not fundamentally form part of your income approach. That is something that I'm trying to say. This will come part of your alpha, so we'll hold on to that particular thought.
Sir, I think alpha is over and above systematic and unsystematic risk both.
I agree, sir. Alpha is over and above. You're saying it is over and above the it is over and above diversifiable risk, is it?
No, diversifiable risk is systematic risk, right? But I am saying it's
undiversifiable is systematic risk, sir. Undiversifiable is systematic risk.
Systematic is what the market as a whole faces.
Correct.
This is systematic. Unsystematic is company specific, right?
Correct.
So when we are looking for alpha, we are looking for something which is beyond unsystematic and systematic both.
No.
What I'm saying.
Yeah. So, okay. Thank you for bringing that up. When we are looking at alpha is the unsystematic risk. Systematic risk, we will be able to evaluate, we will be able to bring it in. When you are coming to a company, in a specific company, it might not be there in the system, but it might be there available in your company in that particular transaction. That is unsystematic risk, and that is what alpha is going to represent. If alpha is going to be apart from systematic and unsystematic risk, what else is there? There are only two types of risk: systematic risk and unsystematic risk. And the systematic risk or the undiversifiable risk is going to be captured in your beta into RM minus RF. There it will get captured. their risk-free rate plus this systematic risk is captured here. Apart from this systematic risk, there's going to be an unsystematic risk or a diversifiable risk. Instead of it, since why it is diversifiable? Because instead of investing in your company alone, he can go ahead and invest in the market where he has diversified everything, and it will become an undiversifiable risk. There his risk is coming down. Therefore, that is, yeah.
I agree with you, but see how investment community look at it is at like the risk inherent in an asset. Okay, that is the intrinsic value of an asset.
I agree.
Because the return should be commensurate with the risk, both whether systematic or unsystematic. An investor, if he is looking to invest in a company, he will be expecting return which will commensurate with both systematic and unsystematic risk. Okay. So that is something which is minimum expected by the investor to invest in that company, and we can call it at the cost of equity. Okay. So that is the minimum which he is expecting. Alpha is something which is beyond that risk, because your risk is already covered in the return. Whether that risk was diversifiable or unsystematic or unsystematic, that return should be commensurate. That is, although the beta calculation, I agree with you. The beta calculation is something which is done on a systematic basis. It captures only systematic risk, but the investment community investment community calls alpha something which is beyond the risk inherent, beyond the risk in something else. Someone else is talking. I don't know who is this. Mr. Shrikant Somipalli.
Yeah, go ahead.
Someone else is also.
Yeah, go ahead.
Yeah, so it can be looked in two perspectives. One is where the return should be commensurate with the risk, and when I call risk, it is both systematic and unsystematic risk. So that is something which is expected by an investor to invest in a company, and that is the minimum. So that is cost of equity. If somebody is generating the return over and above that cost of equity, that I call as alpha, and that is how generally investment community looks at it. Although beta calculations captures only systematic risk, that I agree with you.
Okay, so we'll hold on to that thought, sir. Let us try. Let us agree to disagree for now. We'll hold on to that thought. Let us run it through. Probably at the end, probably I will get a little bit of more clarity, or probably you will get a little bit of more clarity, or probably we'll connect and we'll try to discuss this particular thing. I have a little bit, based on my knowledge, I have a notion of what is alpha, but what you're saying can also be one way of looking at it. So I understand, I agree with it. With you, because at the end of the day, alpha is going to be a constant value. It is going to be a differential figure, just like your goodwill. You expect your asset minus your liability, whatever is the remaining residual value, you call it goodwill. The same way, alpha is going to be that kind of figure. So probably you might be right. We'll run through this session. At the end, probably we'll again discuss on this, and we'll try to understand what this alpha is. Either it is whether it is over and above unsystematic, or is it only the unsystematic risk. We'll try to understand it. Thank you so much for
Santosh, sir.
Yeah, go ahead.
You are going to tell how that alpha is being used in the practical calculations.
Yeah, we'll definitely discuss that.
Okay. Yeah.
That is forming part of the succeeding slide. Probably one slide, but then there we'll have a very detailed discussion.
No, that will give us more clearer understanding of the situation.
If I had to give you a very simple, if I had to spoil the movie for you, then you probably might not be using alpha. So sorry for spoiling the whole session, but then that's okay. You should know what is alpha, because if somebody is going to come and ask you why haven't you used alpha in your calculation, probably that is the point that you'll have to give. And there are very minuscule areas, very small areas where you might also have to use alpha. We'll definitely go through that particular phase.
So alpha is like God. It exists, but we can't see it.
So alpha is like goodwill, if you can, if I can say that way.
Intangible asset.
Yeah, it is an intangible thing. It is a residual value. Some people use it, some people don't mind using it. So that's that. So let's move on to first fundamental concept. It's the capital asset pricing model, CAPM, or your CAPM model. CAPM model is very simple. It states that the return that you are expecting from a particular asset falls into this particular equation, if I have to oversimplify things, it says that the minimum that you would be asking from a particular investment would be the risk-free rate. If you remember Mr. Warren Buffett, he used to say all his discounting he does with the risk-free rate. He does not go into much of the cost of capital. He looks at risk-free rate. He makes some weights, or he adds some premium to the risk-free rate, and he directly arrives at what is the value of that particular investment. So risk-free rate is the fundamental concept where you invest in a asset. Say example, you invest in the US treasury bills, that is the risk-free rate, and then we add up to the systemic risk that is there in the market. So you go to the market, how much you will be able to get in excess of the risk-free rate from the market, which is a perfectly working, fully diversified, or it is there is no diversification possible. So it is an undiversifiable systemic risk in the market. What is the return you will be able to get? That forms the second part here. This is called the systemic risk or undiversifiable risk in the market. Okay, so risk-free rate. What is the systemic risk? What is this beta into RM minus RF? Beta will come a little later. We'll look at RM minus RF. I go to the market. I find out what is the return I will be able to make if I had invested the same amount of money in the market. Say example, risk-free rate is, I'm just making assumptions, 5%. Now, if I had invested the same money in the market over a period of time, what would have been my return? How can we risk-free rate in Indian context? Sir, I take 10-year bond yield rates, which is published by RBI. That probably is there. That is a separate discussion in itself. Why should I take the longer period? Why I should take the government bills? Should I take Indian government bills? Should I take US government bills? And should I add for the country risk premium? So all these things are there. But currently, for the short answer is I take the 10-year bond yield rates of India. Cost of equity considers only beta. Cost of equity considers only beta. Okay, sir, if you can you add what is the context to this particular message, sir? Ramesh, sir. Not alpha.
He says alpha is probably not used, beta is only used. That's what probably he means.
Okay, not alpha. Okay. Cost of equity considers only beta. Okay, we'll discuss about this at the last. So thank you for bringing that up. We'll discuss about this at the last. So now RM minus RF, we know the market return that I'm able to get from the market. I'm going to take it. And then I'm going to remove the risk-free rate, because what is the premium over and above the risk-free rate that is required for me by is the actual amount or the extra risk I'm taking over and above the risk-free rate, or investing in a risk-free asset is what is my extra premium on market return. So that particular amount is RM minus RF. The important point here is, how do you calculate market return? There are multiple ways of calculating market return. Aswath Damodaran, he goes on and he does a market return calculation for the US, and then he adds country premiums for each and every country based on their credit rating, and then he arrives at the market return for each and every country separately. What would be the best way to do for us as Indian valuers would be to go and look at the market, find out what is the market's value, or say example, if you're looking at Nifty, or if you're looking at Sensex, or if you're looking at Sensex 500, or if you're looking at Nifty 500, look at the market return that is coming from that particular market. Then go ahead and you find out what is the future projections, 5-year projection. Just like how do you do a projection for your company, do a projection for the market as a whole. Find out what would be the cash flow for that particular market as a whole. It's a tedious process, it's a data intensive process, but it is a doable process. You can find out what is the past 5 years performance of all these companies. If you take Nifty, it is going to be 50 stocks. If you are going to take BSE, it is going to be 30 stocks. Take that 30 stocks, find out what is going to be the future cash flow for all these 30 companies for the next 5 years. since it's a market company, you'll be able to find out this projection very easily. One important thing is how it is we are able to get this 5 years projection very easily is that there are market analysts who are going to look at that particular stock and they are going to bring back the numbers and they're going to give it to you. So that numbers you're going to take, and then you're going to use the governments or the Indian country's GDP as the growth rate on the 5th year. You're going to discount it back. What is the discount rate you use to find out what is the Nifty today? That is going to be your market. I mean, that is your return from the market. Say today Nifty is about say 15,600 levels, 15,700 levels. You take what is going to be the first year, 2021's return, 2022's return, 23, 24, and 25 of the return, and then you're going to use a growth rate, which will be the growth rate that you assume after 5th year. It is going to be there, say 5%, 6%, whatever percentage that comes to you. They can make an estimate of make a reliable or a informed decision making on the GDP forecast that you're going to make. Discount all these values. There will be one plus R, which will be there at the bottom of all these calculations. It is going to become a polynomial equation. What you're going to do is this equation you solve for that R. The R that you're going to get for this particular equation, that is going to be your market return. Any doubt here, sir? I'll stop here for a minute. I'll try to answer the problems and then let me go back again.
Sorry, sir. I want to ask you that how practically it seems difficult to calculate RM. Could you tell us the site or the way exactly how could we calculate this RM in practical scenario as an Indian valuer?
Very practically, if you want to do it, go to Aswath Damodaran site, madam. You'll be able to. He has given a proper market. I mean, he does it in his own way. He goes on and he does whatever I told you for Indian market, he does it for S&P 500. He does it for the Nasdaq. And what he does is after he finds it out for the USA, he does a country risk premium addition for all the countries that are going to be there. So if US is considered as a AAA rated country, if India is going to be a BB rated country, I'm just taking numbers. I'm not subscribed. I don't know what are the current number ratings are, but he adds a percentage of premium because if somebody instead of the market return from US, if they risk investing in India, there is going to be an extra market risk. To that, he compensate with an extra market premium or an extra market return. So that is how he calculates it. If you want to do it, go to Aswath Damodaran site. Not only Aswath Damodaran site, that is free. That's why we go there. But otherwise, there are multiple market information. I mean, market analysts who are there. They are able to publish multiple information on this regard. You will be able to take it directly. But simplified, if you want to understand how they do it, this is how they do it. They take the day. Say they do it on one single day on say 1st of January 2021. They take whatever is the Nifty rate or the Sensex rate, that particular constituent market or the constituent value, how it is being split up, they would know. That's for that split up. What are the companies that are going to be there? They are going to project for the next 5 years based on reliable market information, which is going to be still it is going to be a projection. They use GDP as the growth rate. And then they're going to discount it back to find out what is the, they cannot discount it. They'll have to discount it to find out what is the value of this particular asset. But now they have the value of the asset, which is going to be your Nifty or Sensex. They are going to use this and the left-hand side and the right-hand side. Right-hand side, the required rate of return is pending. They find out this required rate of return using the left-hand side and the right-hand side. So this is how they calculate RM.
Mr. Santosh?
Yeah, go ahead, sir.
Mr. Santosh?
Yeah, go ahead.
Yeah, this side, Akhil. So generally, what I used to do in practice, I used to take the CAGR of, let's say, 10 years of the 15 years of the Indian market.
I agree, sir.
So what's your thought on that? Whether that approach is a relevant approach or that approach has some drawback, and the guidance, let's say, which is being given by Mr. Damodaran could be the better one?
Sir, I would suggest what Damodaran does, what all these market fund houses do, that is the best approach to do. Even I do CAGR. I used to go back 10 years. What is the return that the market has given over the past 10 years? If we take and if we are going to apply it, that's fine. But there is an inherent risk there. Past 10 years would have been a great 10 years. We have started right from 2008, where the market has fallen down very badly. From 2008, we started till 2020. The past 12 years have been great. but you're not going to look at what has happened on 2020 when you are doing a valuation on March of 2020. If you're going to do a valuation for a particular asset, and that particular valuation you're going to stop from as on 31st, if you're going to do the valuation as on 31st of March 2019, but you're doing the valuation on say 30th of March 2020, you know there is a pandemic that is happening outside in the market. You know that the return that they so far has been earned is a historic return. 2008 you started with a low base. 2020 we already knew we were slowly moving because of the lower interest rates. We were already moving towards a huge number, and the growth is extraordinary. And if you're going to take that number as the base number, and you're going to project for the future, the provisions, the projections that is going to come to you, those are going to be battered numbers, because the industry knows the projections. Also, the company, the management prepares the projections based on the hit that is going to happen in 2020 and 2021. So you understand, right? The projections is going to be a hit number, but the comparison is going to be extraordinary numbers with a lower base. So you will not be able to compare these two together. It is
So
okay. In a normal scenario, we can go ahead and do it. If we are in a normal year, it does not make much of a difference. If you are taking 20 years number, it is okay. But then for this kind of special scenario, you might have to go ahead.
Sir, there are a couple of points here. See, one, we are looking at the return as on date, firstly. So that is one. Point number two is, if you are looking at future earnings as far as market return is concerned, on risk-free capital, why are you looking at 10-year GSEC now? Should we not project how the government finances are going to change, and therefore what the risk-free return will be later? So basically, conceptually, it is as on date, and do it as on date is my view. Secondly, markets all, I mean, if as you rightly said, 2008 was abnormal. So go 20 years, if not 10 years, because markets always revert to mean. You look at you plot 100 years of what the market is, let's say Wall Street or whatever. Markets always revert to mean. The reversion to mean is something that markets always adopt, actually. So therefore, I think it is I would rather err on a conservative side of saying that this is how markets have reverted to mean over the last 20 years, and therefore this is my expectation, rather than looking at things that are unknown. Say, for example, if I had done the same thing of projecting things like what Mr. Damodaran is saying or others are saying, let us say in 2017 I would have done this projection, and then the pandemic hits in 2020, nothing of that holds good. So obviously the future holds more uncertainties than the past. So I would think, I mean, my personal view is that I would rather go by, if not 20 years, if not 10 years, I'll look at 20 years to ensure that I have covered all types of business cycles in a 20-year period. And therefore I would prefer to go there. And I strongly believe that the markets always revert to the mean.
Agreed, sir. Agreed. I endorse your view, sir. Yeah.
Yeah. Okay. So that is one way of looking at it, sir. There is nothing wrong. You take 10 years, 20 years CAGR. That is absolutely okay. As long as it is not, if you're not sitting on 1 year in which there is going to be a huge reversal. I agree to the fact that it is going to revert back to the mean. I agree to it, and there is no problem with this. But I think why he goes for it, or why most of the fund houses go for a projection, is that they are going to look at the overall trends might change. So India, so far, you've seen the story from 2000 onwards till 2020. We are still taking credits for the Y2K. We stood up during the Y2K. We took over the information technology field, and we are able to make a good bucks from there. And we are able to tell the market has been pretty good from there on. But if at all, if things are going to change, you might have to project for it. We cannot just sit on the past. We cannot just say that information technology has taken India, and the market return has been good. We have been an emerging market. There will be one point where we will move on from an emerging market into a more stable market. At that point in time, probably if you keep taking the 20 years or 30 years return, probably that might not be the right solution.
Yeah, fair enough.
So with that, let me try to answer a few chat questions. Are next 10 years predictable given the present abnormality in all the economies? Yes, nothing is predictable. And if to answer the question, if at all there is going to be a future pandemic, or if there is going to be a future slump, we will never know it. But that's okay. No, we are sitting today and we are trying to value that particular company, or trying to value that particular market today. and what I would have signed as a valuation report for a tours and travels company on January 2020 would be completely different if had I signed it on March or April of 2020 when the pandemic was at its peak. So that difference will always be there, and let us learn to accept it. It's okay. That is okay. There will be a difference. We normally do like BSc Sensex for 20 years, maybe inception, and find out rate of return. Is it okay? It is okay, sir. That is CAGR. You can do it. We should be moving on and keep question sessions at the end. Okay, let us try to do that. There are many columns given by Ashwath Damodaran. Okay. Okay, we will look at it at the end. RM gives. How do I mute? Okay. Okay. We are valuers, not astrologers. RM gives due weightage to liquidity. Okay, let's move on from here for now, and then we'll collect the other questions on the way. Now, with regard to this, we had a healthy discussion on RM, how to calculate RM. RM minus RF is going to be your market premium. That is going to be the differential value that you're going to get over and above for taking the extra risk of investing in an equity or in a stock. So that is that. And now let us move on to beta. Beta is an interesting way of looking at things. Now, what we found out is that we fundamentally moved from a debt stock or a bond stock, a debt investment or a bond investment into a stock or a risky investment. We have actually moved classes. We have moved from a no risk or a zero or a very minimal risk investment into a risky investment. There is going to be a fundamental shift in risk. That is why we have done RM minus RF separately. We have added. Usually, if all the assets or all the stocks that are forming part of the market, if it is going to be moving in the same direction, if they are going to be averages, then simple averages, then what we are doing is right. We can add risk-free rate with the market premium. But what happens is each stock has its own mind, each stock has its own future, and it is going to move in a different direction. To correlate this market return with our companies or our sector's return, we use this concept called beta. So what is beta? Beta can be defined as a change in the securities return or the target company's return in relation to the change in the market return. We are just trying to find out my industry, my company, how much is it volatile, or how does it correlate with the market return? If Tata Motors is there, if the market goes up by 10%, if Tata Motors also goes up by 10%, it is perfectly correlated. We will be able to understand, okay, this is how it is correlated. Say, let us understand gold. In the example of gold, what happens is if the market goes up, it probably goes down, and if the market goes down, it goes up. So there is a negative correlation, but nevertheless, there is a correlation. So that correlation is what beta is going to give you. For a given change in the market return, how much is the change in the security yield? We will not be able to find out what is the beta for each and every stock unless otherwise it is a listed stock. If it is already a listed stock, already market information is available, then no problem. Market information is available. We will not be looking at beta at all in the first place. But most of the evaluation that we are going to do, it is going to be a private company. If it is a private company, what happens is that your company is not listed. It is not part of an index. You don't know your company's share is not. It is not bought or sold in the market, and you don't have a market return for it. Therefore, what we do is we find out similar companies in the market. We find out these similar companies, how do they move in the market in relation to the movement of the market in itself. And that is going to give you the beta. Beta is nothing but change in the security return divided by change in market return. So far, any doubts? Let's move ahead. What are the components of beta? So now beta can be, if I can say beta, how do you calculate beta? It is more of a regression. Let me come back to this a little later. Interpretation of beta. Let us move on. I will finish off how to calculate beta and then come back there. How do we usually calculate beta? Is that we go ahead, we ascertain the return in comparison to the index. And how do we do that? We run something called a regression. If any statistician is there in the group, please pardon me. I might be a little incorrect when I quote certain terms in statistics. I'm not a statistician. Pardon me there. But otherwise, when you look at when you're able to get the market return and when you're able to get the company or the stocks return, say example, I want to say invest in a company. I'm trying to do a valuation for a particular stock. I want to do a valuation of a particular stock which is into car manufacturing. What I can do is I can look at Tata Motors. I can take the market return. I can take Tata Motors. Tata Motors is a similar comparable company. For whatever reason, I think Tata Motors is more closely related to my company. It is very much similar to my company. I don't know. I'm small. He's big. That's the only difference. So what I would try to do is I'll take the market return and I will look at Tata Motors and I'll find out what is the beta for Tata Motors. What I will do is I'll run a regression analysis of the return Tata Motors have given in the past 20 years. I will do a regression in comparison to the market index, say Nifty or Sensex. Whatever value that I'm able to get, that would be my beta. But beta as a statistical number, it is not a very reliable number. What happens is, should I use the regression beta? No, because in all of statistics, one thing is for sure. Anything that you run will always carry a amount of risk or error. So in this particular case, when you run a regression, there is something called standard error. And these standard errors are usually given along with the beta value that is being given. Say if a beta of 1 is given, if a standard error of say 0.3 is given, then it essentially means that you'll have to multiply it by 2 and you'll have to add it and reduce it to find out if the beta that is arrived based on this value is 1, it can be as low as 0.4 and it can be as high as 1.6. So there is a huge difference. If it is 0.6, it is not moving, it is not magnifying. It is 0.4, it is going to be much lesser impact. And if it is going to be 1.6, whatever is happening in the market, there is going to be a magnifying effect on this particular stock. So regression beta is something that we don't usually use. Let me go back to this slide of computation. So what I try to do is I try to understand the components of beta. What is the theory? What is the basics of beta? What constitutes beta? So now when I look at the constituents of beta, there are 3 types of constituents that are there: the base component, the operating leverage component, and the financial leverage component. The operating component is the inherent nature of the business in itself. Operating leverage is the fixed cost to variable cost differential that is there. And then financial leverage is the debt to equity ratio that is going to be there in your business. So with regard to the base component, based on your product, if your product is a cyclical company, the product is going to be a cyclical business and it is going to be a cyclical company, then that particular kind of company will have a higher beta in comparison to a non-cyclical company. Usually, what is a cyclical company? A cyclical company, it is mostly it will be luxury-oriented goods. It will be goods which will be not essential in nature. So, if the market is behaving badly, if there is a crisis that is happening in the world, then the markets will go down. At that point in time, who would be ready to go and spend their time in a luxury hotel? At that point in time, there is a magnifying impact on this particular kind of the risk that it has been magnified, and therefore luxury goods will have a higher beta in comparison to essential goods. Business selling at higher prices will have the same impact. If the product is of higher price, what happens is that the value of this particular asset will when you look at how it is, the return is getting affected in relation to whether that particular business will run in tandem with the market. Yes, it runs in tandem with the market, but it actually has a magnifying effect. You will be having when the market is performing good, there will be a lot of people who will be available in the market who are ready to purchase your product. But when the market is not performing that well, then there will be even lesser people who will be ready to buy your particular product from that particular market. Then growth firms will have a higher beta, and stable companies will have usually a lower beta in comparison to growth firms. See, beta is more of a relational function. You look at the market, you look at other companies, and you do a relational analysis of the beta. So it is not a single number, it is not a standalone number. When you come to operating leverage, if you have, say, everybody would have heard about the Hyatt fiasco now. Hyatt has a lot of hotels. they have a huge fixed expenditure in comparison to other companies. Let us say what is that? Oyo rooms. Oyo rooms is also into providing you spaces. Hyatt is also into providing you spaces. Oyo has to pay, has to make an expense if and only if what happens if the rooms are getting booked, they'll have to make payments. But when it comes to Hyatt, they have that fixed infrastructure in place. Whether that particular company, whether somebody is going to occupy that room or not, they'll have to maintain that room. The swimming pool, whether somebody uses it or not, they'll have to maintain that swimming pool. That is going to be there. If that kind of expenditure is going to be there, it is going to make your good times even better, bad times even bad. That is the reason when other companies are able to somehow sail through, these big companies, Hyatt and other hotel-based companies are struggling to cope up because bad times have made it even worse. Therefore, the companies with higher fixed expenditure or fixed cost, they are going to have a higher beta in comparison to companies which have higher variable cost than their fixed cost. Small companies, again, small companies are going to have a higher beta than larger companies because the fixed cost component, when you look at smaller companies, they also have to have the same kind of fixed cost. Larger companies, they also have to trying to have a same kind of fixed cost, but the percentage of the total cost when you compare it with a smaller company, the higher company, it will be much smaller. Why? Because it is getting averaged out. You know about overheads, how they get averaged out. The same way, the small companies, the fixed cost will be a huge amount, but when it comes, when the company grows and when it becomes big, this fixed overhead will become a smaller part of their total cost. Then businesses that are young, again, young companies tend to be smaller companies, their fixed cost will be much higher. When it grows and it stabilizes and becomes established, the component of fixed cost in comparison to their total cost comes down. Therefore, young companies, small companies, and companies which essentially have more fixed cost will have a higher beta in comparison to other the opposite. Finally, let us quickly run through financial leverage. A company, when an investor, he wants to invest in a company, he can do it in two ways. One, he can take debt instruments from that company, or he can take equity instruments from that company. If somebody is risk averse, he wants to reduce his risk, what he does is that instead of going for equity, he goes for debt instrument. Obviously, he's going to get paid a lot lesser, but that will be compensated for the certainty of the return. He's going to get definitely paid the principal as well as the interest. Now, when you look at this, the risk that the investor is evading, the risk that the investor is moving away from him, it is actually going into the company. The risk that the investor, the debt investor, is going to remove from his investment is actually getting factored into the company. And this risk that the company is holding, it is going to factor into the equity holders of the company. When I do not want that risk, I come out of it, I push that risk to the company. The company in turn, it pushes it to the equity holders. I'll give you a simple example. 100 rupees is the amount that is required to run a company for doing a business. The company takes that 100 rupees, he goes to the market, he buys some product for 100 rupees, he sells it for 150 rupees, and that 150 rupees he is able to give it to the equity holders. He is earning you say 50% return. This is an ideal company. Say 30 rupees, 130 rupees he sells, he gives you 30% return. Now enter a debt investor. Now what has happened is the entire 100 rupees does not come from the equity holder. That the equity holders have decided that 50 rupees is going to come from equity and 50 rupees is going to come as a debt. And there were some people who were pushing for reducing the risk, so they wanted to take a debt instrument rather than an equity instrument. 50 rupees comes as equity, 50 rupees comes as debt. The same 100 rupees is going to go into the market. The return is not going to change from the market. You're going to get 130 rupees back. Once you get 130 rupees back, the debt holder is supposed to get whatever investment he has made plus the guaranteed return he is promised. For 50 rupees, he is promised 5 rupees. Let us understand it is 5 rupees. He will take that 5 rupees plus 50 rupees, which is going to be 55 rupees. He settled. What remains with the company is 50 rupees plus 25 rupees, which is about 75 rupees. So the equity holder of this particular company, though the business is able to get only 30% return, he is able to make a 50% return. 100 rupees invested by the company is able to get 130 rupees. But the equity holder of the company has invested only 50 rupees, but he is able to get 75 rupees. This 25 rupees, which is the 50% margin or 50% return that he is getting, is why? Because he has taken an extra risk. The debt holder, he has reduced his risk and he has pushed that risk into the company. The company in return, he has pushed that risk automatically. If company is taking a risk, it is automatically passed on to the equity holder, and the return also he has pushed it to the company, and the company has moved it to the equity holder. This is understood. So this is the financial leverage that is happening in a company. In this particular scenario, when you look at debt, the beta of the debt is 0. Predominantly, you can assume beta of a debt is always 0, because whatever happens in the market, the return that the debt holder is going to earn will not get affected because of the happenings in the market. Therefore, we factor that zero value of beta into this particular formula, weighted average, and then we also factor the tax component. Equity holders, if the company declares equity holders dividend, if it is going to give equity holders any return of money, the company is not going to get any tax benefit. But when it goes with a debt holder, it does get some tax benefit because it is paying an interest, and it is going to be, for the purpose of taxation, is going to be considered as an outsider. So in this regard, this financial leverage that is happening, we will be having an impact that will move the operating, the base adjustment or base component. Operating leverage will give you the unlevered beta, and when you remove out the zero beta of debt, it becomes the levered beta. Okay, now that will become your levered beta, and when you remove out the zero component, then it becomes your unlevered beta. So I'm taking out the beta of the equity holders, and I'm looking to trying to find out what is the beta of this particular business alone. Now, moving on, how do you interpret beta? Beta can be positive, it can be negative, it can be 0. So let us try to understand the common betas that are available. Usually we break it up into more than 1, less than 1, and equal to 1. When it is equal to 1, it is pretty simple. When the beta is equal to 1, when the market, whatever direction it is moving, in tandem, in the exact manner, in the exact direction, your stock is also going to move. Predominantly, stocks do not move in this particular fashion. They do not have a equal to 1 beta. Very few stocks have equal to 1 beta. But obviously, when it is tending towards 1, then there is a tandem movement. If the beta is lesser than 1, then it's a different story. The market, when it moves, if it is giving 10% return, this stock is going to give you 5% return. If the market is going to give you 10% negative return also, it is going to give you negative 5% return. It is moving as a percentage, but it is moving in the same direction as the market. This is the interpretation of beta with a less than 1 value. And then finally comes your beta greater than 1. When you look at beta is greater than 1, it essentially means that any movement of the market is exaggerated in this particular stock. If the market is moving by 10%, this stock is the one which is actually made the stock, the index move up by 10%. So 10% movement in the market, you can actually see the company moving 20%. And if the market is moving negative 10%, the particular stock has actually moved negative 20%. So this is the effect when the beta is greater than 1. The more the market moves, it will be almost as a 120-130% of the market movement. It magnifies the result. When you look at it, if the blue line represents the market's return, it might go up. I've just taken a simple sinusoidal wave. I did not do much of a change there. It's a simple sinusoidal wave. When you look at it, when the market goes up here, it comes down here. When you look at a beta with lesser than 1 value, it does go up in the same direction. When the market goes up, this beta, the beta of a stock which has a lesser than 1 value also goes up, but it does not go beyond whatever the market is earning. If say this is 1, it is able to make somewhere around 0.3. But it does not make a loss. When the market is moving up, it does not make a loss, but rather it moves in the same direction but at a lesser rate. So this is a beta with lesser than 1 value. When you look at a beta with more than 1 value, here if you see, when the market went up by 2, it went up by when the market went up by 1%, the market gave 1% return, this particular stock is able to give you 2% return. When the market came down by 1% return, then this particular stock went down by 2%. So a beta, when there is a, can beta be 0 or negative? I'll come to it in the very next slide, sir. So when the market is performing in a way, and if your stock is going to overperform it or magnify the income, the ups and the downs, it is having a beta of more than 1. If it is not magnifying it, if it acts in the same direction but it acts a little lesser than it, then it is going to have a value of lesser than 1. Now let us move on to the next one. If you have any doubts, you can stop me here. Okay. Can a beta have 0 or negative values? Beta 0 means it is risk-free stock, or it is negative, then stock is much safer than RF. It's not necessarily it is safer than RF, sir. We will discuss that. 0 beta is not an anomaly. It is there in the market. If you look at gold stocks, it predominantly acts in the opposite direction. Usually, even real estate stocks used to function like that. When the market is getting hit, when the stocks go down, the real estate stocks and the gold stocks used to go up. And then when markets are down, markets go up, these stocks used to go down. This used to happen, but now real estate is not much of a trouble because a lot of real estate companies have come into the market. So they also started slowly. The investor sentiment has also changed. So they also look at it as an in par with the equity instruments. So therefore, they move in tandem with the market now. The place where you will not find any difference is your risk-free deposits. The deposit that you have made with a bank, say, let us assume if you are going to compare it with the market, whatever happens in the market, it is not going to have any risk component to it. Whatever happens in the market, I'm going to get my deposit. The PPF that you have put, the PPF asset that you have, it is not going to be dependent on the market. All these independent characteristics can have a 0 beta. And apart from that, you can construct a portfolio of assets in the market also. These are all items that I've PPF, or the items that I've told, the fixed deposits, they're all out of the market. You can have assets from the market also, put them into one basket. If you can put certain assets in a certain way with a certain proportion, you can make a portfolio with a 0 beta. So I have two assets. One asset has a -1. I'm just giving you a rough example. One asset has a -1 beta, and I have 50% of that asset, and there is another asset which has +1 beta, and I have 50% of percentage of it. When I do a weighted beta, the portfolio value becomes 0. So whatever happens in the market, the loss that this stock is making, the other stock will be able to cover, and the loss the other stock is making, this stock will be able to cover. This essentially puts my value of beta as a portfolio as a whole to 0. This is what a lot of companies try to endeavor to do also, because they want to earn the money, but at the same time, they do not want to lose out on the market movements. So this is something you might have to know about the 0 betas. And then negative betas. Negative betas, it is not out of the realm of reality. It is still there. They're very hard to find. Predominantly, it is gold. When you look at the market, when the market goes down, gold goes up. That the previous case study that I told you, it is still holding good. Real estate has moved out, but gold has still remained the same. Now, let's move on. This is a quick pictorial representation. If this is the market return, the blue line represents the market return. The green line represents the negative beta stock. When the market goes up, your negative beta stock actually goes down. It can be, if it is going in tandem, if 1% increase in the market return gives you a negative 1% return in your stock or in your asset, then it will have a -1 beta. But it can not necessarily will have to have a -1 beta. If it goes in the opposite direction, then it is a negative beta.
Does it happen practically? Practically, does it happen?
What's that? Whether do you have any stock which actually goes in the opposite direction?
Yeah, negative beta.
Yeah, so gold, if you consider gold as an asset and when you compare it with the market, yes, because you're taking two different assets. So when you look at these two assets, the point is not necessarily these two assets needs to be related also. So that is how when you look at gold and stocks, there is a possibility it will go up or down based on this. And if you want to relate more, look at gold mining companies. They also behave just like gold, because the more the value of gold, the more their value also. They act like gold. Therefore, when the market keeps going up, their value keeps going down, and when the market keeps going down, their value keeps going up. Gold stocks have a beta of negative value. MNC pharma are considered different stocks. So different stocks, when you look at it, it is not negative beta per se. They are saying different stock because see, technology and all, you should consider it in the previous context. When you look at technology stocks are the stocks that are driving the market. They will make your good times better. If the market is going up, it is because of these stocks. So therefore, they're having a more than one beta. But when it comes to different stocks, you're talking about MNC and pharma. Let us take even technology sector. You take Wipro Technologies for that matter. Their public float is much lesser. Therefore, what happens is that they are different stock because though the market goes up by 20%, they will definitely go up, but they will go up by 15%. They will go by 12%. When the market goes down, still they will go down. They will also go down. It is not that they will go up, but they will go down to a largely a smaller, significantly smaller percentage. And that being said, you cannot hold it hard and fast. It is not a hard and fast rule. In the case when the corona hit, the market was going down, pharma stocks were going up, because that's a different story. Because they found out an opportunity. The future was different for the market when you compare it with the pharma companies. And MNCs in today's scenario, gold prices is much related to the global market rather than the Indian. Never has gold ever been related to the indices, sir. Gold has its own index. It is a commodity thing altogether. It is not related to the indices. It has always been a global phenomenon. If Sensex goes on, prefer stock than gold. If Sensex goes on, people prefer stock than gold. Okay, we are saying if it goes on, you never know, sir. That is the reason we'll have to look at the forward. You should look forward whether things are going to be bright, things are not going to be bright. You'll have to estimate and you'll have to calculate. Then only you'll be able to say. One stock cannot be said as different stock always. It depends on market. Okay, yes, true. Right. Now, let us move on. And finally, we come to zero beta. Zero beta is very simple for me to explain. It is going to be a straight line. Whatever happens in the market, it's going to be there. It's going to give you some return. It is going to be separate from the market. It is not related. It will act as if it is not related to the market, though it can be related to the market. As I told you, 2 stocks, 1 portfolio, that can happen. Now, levered and unlevered beta. Levered beta is the beta of a company which has both debt and equity. Unlevered beta, I have oversimplified things here. I'll try to put it back into context. When I'm saying a company with debt and equity and with a company which has only equity, when I'm saying unlevered beta, it is the beta of the business. What is the beta of that particular business is called the unlevered beta. When I'm having an equity holder in that particular business, equity holder is the business. So therefore, the investment that he has made, it is completely in the business. Therefore, what I have as equity holder only is the business's beta. When you look at levered beta, as I told you, this particular person is taking a higher risk because the investment, the money invested into the company is not only his money, he has taken loan from somebody. He has leveraged his position, and therefore there is that particular person, though the business is giving him 30%, they say 30% return essentially means 30% risk. Since his return is increasing, then essentially it means that his risk is also increasing. From 30%, it has moved to 50%. How has it moved to 50%? Because the 5% only zero risk that the debt holder is taking. So with that, let us look at how the correlation functions. This is a formula we usually use for calculating levering and unlevering the beta. Usually, debt does not have any beta related to it, because when we take assets, when we look at comparators, we look at only comparators which are stable in nature. We will not take a company like GameStop for calculating beta. I'm going to do a technology company's beta calculation, I will not take a company like GameStop. I will not take a company which is fundamentally very weak, which I do not know whether it is properly correlated or not. Also, if you actually look at GameStop's valuation, if you look at beta of GameStop, it is actually negative. when the pandemic was raging, this particular stock was actually going up. It went up from 20 to somewhere around 400. It came down to 40, but still as an overall basis, it has made a positive movement. Therefore, I will not take it. But then if that it comes down to it, you'll have to break it down. See, this beta levered, beta unlevered equal to beta levered into equity divided by debt into 1 minus tax plus equity. You can add, we are assuming beta levered is the leverage of the equity. You can say beta of the equity. Weighted, find out what is the debt divided by equity plus debt as in the previous one. And you can, if you can arrive at the beta of the debt separately, give the beta of the debt separately, you'll be able to find out beta unlevered, including beta of the levered equity and beta of the debt together. But this is something that we usually don't do. We assume the beta, beta of debt securities is always 0, and we go ahead. Now, how to calculate beta? We saw this. We went through this. Now, steps to calculate beta. What are the steps that we usually use to calculate beta? We'll just quickly run through. How do you lever the beta when the equity net worth is negative? Good question, sir. When you, how do you lever beta when the equity or net worth is negative? When you are saying net worth is negative, you are saying your equity value itself is negative. Okay, so this beta unlevered component, still it will have, you can very well do it, sir. So equity values will be, this will become 110%. Let us take out tax for the consideration. Debt value will be more, debt plus equity will become 110, and your equity will become, this is what I assume, equity will be negative, is it? Debt will become 110.
Yeah, let's say minus 50. The equity is minus 50, debt is 160. Okay, so you will have minus 50 by 110. So what happens, you know?
Minus 50 divided by 50, because debt is how much? So
fine. You say 50 or 6, whatever.
But debt plus equity will always be 100. Okay, debt plus equity will always be 100, and your equity, you are saying it is minus 50.
Yeah.
Minus 50, it will be minus 1 by 2. Your beta will become a negative value then.
Yeah.
Interesting question, but possible within the realm of thinking. What we will have to do is, it is minus 50 divided by 100. Your debt would be say 150, and your equity is okay, and your beta levered you will have, you are trying to find out beta unlevered. When you unlever it, it is going to give you a negative value. Then it essentially means that you have a negative beta then.
Yeah. So,
but beta levered also will be negative, no?
Yeah. Both levered and unlevered will become negative when net worth goes negative. So the challenge is, I mean, it is not representative of, that it is that the stock is moving in the opposite direction or anything. So the question is, how does one address this, from a valuation perspective?
This is a good question. We'll come back to this a little later.
Yeah.
I understand your concern. I am unable to think in this point in time.
No,
Probably I'll think about it. We'll connect on this.
Oh yes, no problem.
Can we do, in this case, beta can be projected on future projected debt and equity?
Something, there has to be a way out to do this. So I haven't, and frankly, I've also tried talking to a lot of people. I haven't, kind of reached any consensus in that sense to say,
This entire presentation is out of my musings with multiple valuers. The entire presentation has been from me talking with multiple people. Yeah. I had a simple doubt whether cash needs to be forming part of your working capital adjustment in a free cash flow model. That was a doubt that I had. It might sound a lot stupid, but then I had that doubt. I went through multiple places. I was unable to find out, but then somewhere I was able to gather that information. Like this, multiple informations I've got from multiple people. So that's how I improve. This whole presentation has come out that way. So this is another thing that has come to me. Thank you so much for bringing this up.
No, I have a solution to this.
Yeah,
I think we can use industry beta in this case. In exceptional cases, we can take industry beta. This is my view.
No, but let us say if this particular entity is highly levered, more than what the normal industry leverage is, that is a challenge. When you unlever
I agree. What I'm saying is when you you will take the beta leverage unlevered beta of the industry, and you will lever it with the debt ratio of this company, this entity. So you will arrive at a beta which is a representative of leverage of this company and beta characteristics of the industry as a whole.
Yes.
I mean, we have to find solution to something which because if it is negative, then
you don't get a debt equity.
Expected return will become negative, or risk-free rate it will be below than risk-free rate. So we have to use industry beta in that case, I think.
Yeah, fair enough.
But I'm pretty sure, sir. See, he's saying
one thing, Mr. Santosh. So I think so. Whenever we work this levered and unlevered beta, we will not take the exact debt equity ratio. We'll try to make it a long-term horizon of the debt to equity ratio with company as are targeting or projecting.
Correct.
And over a longer period of a time, the net worth should have been positive. The equity balance should be more than the debt balance.
No, that's target debt equity ratio, Akhil. That's not the absolute numbers that company is targeting. The target debt equity ratio you have to take, but the actual value of the debt and equity will be today itself.
As on date. See, you're doing the valuation as on date.
But while looking for the unlevered and levered beta, the debt equity component or the ratios should be the target one, not be the actual one.
Yes. The ratio should be the target one, but not the absolute numbers. This is what I'm saying. At present, when we are taking.
Yeah.
This can be for multiple years also. For multiple years, you can go with multiple betas and multiple cost of capital altogether. If I'm looking at first year, second year, third year, fourth year, and fifth year, for the next 5 years, whatever cash flows that I'm having, not necessarily I'll have to use the same cost of capital for the next 5 years. I can use different betas, come out with different cost of capitals, and I can discount them each of these particular years. I can discount it with a different cost of capital also. At that point in time, what is my projected debt equity ratio in the next 5 years? I can individually assess, and based on that, I can calculate the beta and I can discount it. That is one possibility. That is one way of looking at it.
But if the net equity is so much negative, then probably the lenders will take the company to insolvency under IBC.
No, it need not be.
And their entire balance is going to be written off in that case.
Yeah.
No, it need not be as negative. Even if it is very marginally negative, so your debt equity will, you will not be able to arrive at a debt equity ratio to lever the beta. That's the point.
Correct. You'll be able to arrive at the industry beta. That shouldn't be a problem. But levering it into your calculation, that might be a little bit.
Even if it is a 1 rupee negative net worth, you can't do the levering it. That's it. Yeah.
So
one option is to just keep the equity value at 0.01. Okay. And then arrive at a debt equity and lever it.
Yeah. So all you'll have to do is you'll have to add 50 rupees here, 50 rupees in the debt side of it.
Yes.
That is one way of.
Or just keep it at just 1 rupee equity. Just keep it barely positive. Keep the debt as it is and keep the equity as just 1 rupee.
No, that is a problem, sir. What you'll have to do is you'll have to assume an equity holder is going to bring in, if it is minus 50, the equity holder is going to bring in 50 rupees and the debt holder is also going to bring in 50 rupees. Make 200, make this 0, and then 1 rupee here, 1 rupee and 201. Like that you can do a little.
Yeah.
But then it is highly leveraged.
Yeah.
So essentially what you are meaning is that beta will be so high that if the market moves by 0.1%, your particular share is going to move down by 20-30%.
Yeah, and
actually that's good also. Since the company must be in a huge loss making, and if somebody wants to invest, he definitely going to
it takes a much higher return.
Yeah. So the beta is coming higher. That give a confidence into the calculation also.
See, end of the day, a higher beta translates into a higher cost of equity. That's all. See, end of the day, that's what that adjustment happens.
Yes.
You're doing that to adjust your cost of equity as compared to the index or the broader market. So when you just keep it at 1 rupee, as you said, add the debt as well, and you'll get a very high cost of equity. But fair enough, for a loss-making company, that's a kind of cost of equity somebody will be looking at it. No, I'm just, as we discuss, I'm trying to arrive at this solution. That's it.
No,
please go ahead, sir. Sorry for interrupting.
I would like to come in.
Go ahead.
Thank you. So I think it will give us very skewed result in terms of the cost of debt and cost of equity because of the levered thing and the overall return expectation, which will again kill the enthusiasm of an investor. So we have to look for a long term, what is the industry debt equity, which is the ideal that any businessman has to aspire towards. That is the way one will have to look, because even though the number or valuation date is current, we are looking at what the long term is and what the industry aspires to. Like certain industries are 30-70, 50-50. Infrastructure company can go up to 60-40 also on the long term, not as on a particular date. So we can take a cue rather than going one equity and a large amount of debt. That kills the whole company.
We agree to it, sir. So what we are trying to do is we agree that we will not be taking at whatever is currently happening. We are going to look at the future. But when you're looking at the future, as I told you, first year, second year, third year, fourth year, fifth year projections are going to be available to you. Based on each year's debt equity ratio, separate cost of capital can be arrived at. What we are trying to figure out is, at least for the first year, it can still remain to be there can be a negative net worth for the company. Probably a second year, third year, fourth year, and at the end of fifth year, we can align it to whatever has happening in the market. We can see the fifth year it is aligning there, but at the very next year there can be a negative value. That's where we are trying to match it up.
That is fine. That is a part of a subset of a larger chain of year on year that we are computing, because majority of the value then in such case will come from the later years of the forecast and the terminal period.
I agree. I agree. So now let's move on. How to calculate beta? This we went through step-by-step guide, not my guide. This I have taken from few people, including Ashwath Damodaran. The first thing that we do is go ahead, do an in-depth analysis of what the company is into, what are the businesses that the company is into. When I say target company, I am talking about the company that is the company that we have in hand, the company for which we are trying to find out the value. Now, in this particular process, we find out all the companies that are available in the market, not just in your country, not just outside or in your particular region. Try to find out all the companies which are into similar kind of business. Here, the only thing that is going to constrain you is the companies that you're going to see should be in the similar kind of business. The countries do not bother you, other factors do not bother you, the size of the company do not bother you. So if I'm going to make an auto company, say example, I have a car company, car manufacturing company, I am looking at the market. I should not look at only India. I should look at the US. I should look at Europe. I should be able to take companies from there. This is point number one. Point number two, I should also not worry about whether this company is smaller or whether this company is bigger. When I do that, I actually kill out a lot of, if I try to compare this small company, private company, it's definitely not going to get listed in the market. Therefore, I should be looking at companies of all sizes, not just large cap companies. I should look at large cap, mid cap, small cap, all types of companies I should be able to take. This is point number one. Point number two, go ahead and find out the regression beta. I told you regression beta is not good because it is going to give you, it is having a huge standard error. There is going to be deviation from the standard. Whatever beta that we are going to get is not reliable. But then we should not stop with finding out the regression beta. What is going to happen is that we are going to average it out. When you average it, there is going to be a impact. There will be places where, since we are doing a simple average, there will be places where there are going to be errors on the downward. There are going to be errors on the upward. The upward and the downward errors are going to compensate each other, and it is going to give a better information. This is with statistics. The more the data that you're going to take, the better the quality of the result that you're going to get. So this is with regard to the regression beta. Now, once you get the regression betas in hand, you try to find out all this beta. You made an average that is going to give you your sectoral beta. That sectoral beta will be a levered beta. What we try to do is we go out, find out the debt equity ratio from the financial statements of all these companies that you have worked out the betas for. Then that particular debt equity ratio, you're going to make an average of these debt equity ratios to find out average debt equity ratio for this particular sector. And we are going to unlever this beta, just like in the previous formula. We are going to unlever it using this sectoral averaged debt equity ratio. We will unlever, that is the unlevered beta for that particular sector. This unlevered beta, we need to refine for certain items. If there is a predominant my company, I have a huge fixed cost in comparison to the variable cost. But when I look at all the companies I've taken for comparison, they have a very minuscule amount of fixed cost. They have a small difference. The product characterization is a little different. When you look at a company like Tesla, they have a huge product differentiation when you compare it to another auto company. They operate as if they are a technology stock. So that kind of operating adjustments, operating leverage, and other base characteristic adjustment needs to be done on this particular beta, sectoral unlevered beta. Now, after you find out the sectoral unlevered beta, then you go around and find out what is the weighted beta. How do we do that? Now, the target company can be multiple businesses. Take the unlevered sectoral betas for all the sectors and find out the weighted beta by using the value derived from each of the business to the target company. So now I have a company, say Tata Motors is into commercial vehicle manufacturing. It is also into passenger vehicle manufacturing. But Ashok Leyland is probably only into commercial vehicle manufacturing. Let us assume Tata Motors is a private entity. I want to find out the beta for my company. I will look at the market. Ashok Leyland only makes commercial vehicles. For our understanding, let us quickly assume that way. I will take that beta. I should not use only that beta. I should look for another company, probably Maruti Suzuki, which manufactures passenger vehicle. I will take that particular the beta of companies which have passenger vehicle manufacturing experience also. I will take that beta based on my weight or my exposure to customer vehicle and commercial vehicle. I will be allotting weight for the different betas that are there. Different betas that are there, the weighted beta that I'm going to arrive, this will be the beta which will be more refined, because I am into two businesses. I've taken the betas for two different sectors which are there, which are following my business, and then I'm going to take them based on my weightage. How my value is going to get determined, I'm going to allot the weightage. Now this weightage, it is a very tricky concept. Ideally, how much each business is going to contribute to the value of your business is what we are supposed to take. But how do you ascertain what particular business is going to contribute how much value to the particular company? That there is no exact way of saying. Probably revenue, probably profits. What is the revenue might give you a broad guidance, profits a little better guidance, but you'll have to take what is the percentage of profit as a percentage of revenue. So if there is going to be 100 rupees and 50 rupees revenue that is going to come in, but 100 rupees is not able to contribute, it is not contributing only 1 rupees of profit, but 50 rupees is able to contribute you 5 rupees of profit. Okay, 5 rupees of profit. So essentially it means that 1 rupee plus 5 rupees, 6 rupees is the value addition these businesses are able to bring out totally, of which the customer vehicle division is able to bring you 5 rupees profit, and that will be adding more value. So you'll have to give a weightage of weightage 5 plus 1, 6, and 5 divided by 6 will be ascertained to the customer vehicle manufacturing, and 1 divided by 6 will be given to the passenger, commercial vehicle manufacturing. Now, moving on.
Mr. Santosh, just one thing.
Yeah,
so when you mention in terms of benchmarking the betas with the industry and with the counter piece, so one thing I want to learn from your experience, for example, these days there are a lot of startups in India, not these days, from last 5 to 7 years. Correct. So these startups are definitely based out on the technology, but into a different industries. Somebody is going to be the food industry, somebody is going to be in real estate industries. So when you're going to relate their benchmark, you're going to do benchmark for the IT companies, or you're going to do benchmark to the industries to which they are actually supporting.
Correct. So that is a very tricky question, sir. You should be able to find out what part of food, if they are into a food startup, food based technology company, you'll have to see the primary thing is going to be technology. But when you say technology, please don't go to IT, Infosys, or Wipro, or TCS. They are not
because
technology companies.
they are very body shopping companies. They are the yes.
They are
Agreed.
L1 kind of engagement companies.
Yes.
They are recruitment companies. So we
Yes.
cannot directly look at them.
Agreed.
But what you can see is even today, Wipro, Infosys, they are trying to become a technology company. That's a different story. They are now about 20 to 30% of their revenue comes as a product-based revenues or technology-based revenues starting to flow it. But look out into the market. Look out into US. Try to find out what technology companies are there in the US. What are their betas and try to import them. This is one part with regard to the technology. When you are looking at food technology, food based technology, not necessarily you'll have to go and find out what is the value that food or restaurant industry is able to make, because they are not into the business of restaurants. They are into the business of technology. Technology, the application might be different. Not necessarily if you are trying to concentrate, if you are trying to narrow down too much, each business in itself is completely different. If I buy a Tata car, I buy it for safety. If somebody buys a Kia car, they buy it for the purpose of for the features that they are going to give. If somebody buys an Audi car, they are going to buy it for the luxury component that is there. The Benz car, they are going to buy it for the luxury component. So though the features, though the if you ultra narrowing down, you will be able to find out differentiation. The base, the automobile industry is going to remain the same. The same thing goes here also. Technology is going to remain the same.
Yeah.
It is going to be fundamentally a technology company only.
So will you able to get some listed peers in India for the technology companies? Yes, Infosys, TCS are not the relevant benchmarks.
Correct. We can find out, sir. If we can spend a sufficient amount of time, I think, see, you should not just look at only large cap stocks. Go to small cap stocks, go to mid cap stocks. You'll be able to find out some companies which are into that particular field. There used to be one company called HOV Services, which automated some a little bit. They are purely product company. They do not, their stock got better, different story, but they are a technology company. When you look at, say, if say Paytm is going to come into play, they are more into banking nowadays, but then it started out as a technology company. If it gets listed, it is a technology company. Yeah. And the same way it goes for multiple other companies. I can name a few.
Zomato, for example.
Zomato, for that example, it is if it gets listed at all, then it is going to be a technology company only. Though they cater in a different industry, the base is technology.
Okay. I will connect with you separately on this. Thanks.
Sure.
Yeah.
Which company should be used as benchmark in case if there is a startup of online apparel business? Just to clarify, an online apparel business, madam, you should take Amazon. If you are taking online apparel, if Flipkart is getting listed here, take up Flipkart. Otherwise, you take Amazon. There are companies like this which are there. Snapdeal, kind of, if it is getting listed, if you can get data of Snapdeal, yes. If you look at the US, there are Amazons. There are multiple companies of e-commerce platform. Narrow it down, you can find out 3 to 4 companies. But if you are looking online e-commerce, then the predominant revenue is going to be a technology. The product is what is more important than the product selling part of it. Look at technology companies and take the base there. Now,
so one thing, when you mention using the benchmark of the US, so generally I don't feel comfortable. The economy is different, the macro factors are different, the interest expectation, the GDP levels are totally different.
Correct.
I don't feel comfortable using the US counter, using the benchmarks and applying.
Right.
So just my thought. Yeah.
Yes, you should not take the market return of US. That will affect your valuation. But you can take the beta. Why take beta? Beta is a relational factor. How this particular type of company is acting in relation to the index in which it is placed. You have numerator also, which has the same macroeconomic factors. The denominator, which is the index also, which has the same macroeconomic factors. They cancel out each other. So you just find out what is its relation with the index alone. When I'm taking Amazon, Amazon is not from India. It is from the US. The economies of scale are different. Things are different. But when you look at it, the index that you take is also the US index. You're taking S&P 500. You're taking NASDAQ. The indexes cancel out. This is a relative measure. I'm just trying to find out how much my first, how much well-read I am in comparison to my son. How much capacity is able to retain in his mind. If we do it to the same father and son duo in the US also, it will return the same value. Probably their vocabulary will be different. Probably their language might be different. but the comparison, we are going to compare a comparative. Therefore, that will not have an impact.
Okay, thanks. Yeah.
Now, multiple unlevered beta. This is what I've been telling. When you are looking at the future, go ahead, find out what are the if the business composition of the company is expected to be significantly different. Today, the fixed asset to variable, fixed cost to variable cost is a little different. As we move ahead for the next 5 years, it is going to significantly change. Then it is not a problem. Go ahead, find out the beta using that fixed asset, fixed cost to variable cost levering. Do it for the next 5 years. Find out different betas. That different betas, find out the future 7, 8, 9 and steps, 9th steps, and then you go ahead and apply it in your calculations. This will change your cost of capital, but cost of capital also you change it for the first year, second year, third year, fourth year, fifth year separately. Now we have been using R as the only factor. One cost of capital all 5 years, but change it, it will still give you a better estimate. Next, proxy beta. With whatever weighted beta that you have gotten, come back to your company, find out what your target company's debt and equity structure is. Then you lever it back to your company structure. That will give you the proxy beta. This is the comparative beta that you will be comparing with your the market. You have changed it to a comparative figure and you are applying it to your company to find out the value. So this is your proxy beta. Now this proxy beta, again, when you levered, you have levered it for one structure. As we discussed earlier, we have been levering it for one debt equity ratio as it stands today, but not necessary you'll have to do it as on today. Next 5 years, there will be multiple, there will be change in the balance sheet. The debt and equity structure for the next 5 years is going to be different. That 5 years debt equity change in the debt and equity, you can factor it inside by using multiple betas there. For year one, I have a different debt and equity structure and different fixed cost, variable cost structure. I can put that together and I will be able to find out the beta for next year. The very next year, there is going to be a different fixed cost, variable cost based on my projected financial statements, different debt equity ratio based on my projected financial statements. That put together, I will be able to find out what is the value in the second year. Same goes for third year, fourth year, and fifth year respectively. And then you discount back to find out what is the value of that particular company. So that is the multiple proxy betas. Finally, cash adjustment. This is something that it is a little peculiar. When we do a business valuation, we predominantly tend to think that this business valuation that we are doing, it is more like a portfolio. The assets minus liability, which is the business as a whole, standing at one place, and the cash, bank, and non-operative assets standing at the other end. When we are doing this kind of valuation, go ahead, find out what are the non-operating assets in all these companies. Usually they are assumed at a zero value because cash will not carry any variation with regard to the market. The balance sheets that carry cash, we remove them, find out what is the component of cash to the total assets of the particular company that we have valued, remove that cash component using the same weighted averaging of betas that we have seen, remove the cash component. That gives you the actual beta of only the assets and liabilities that contribute to the business of that particular company, of the comparative companies. Take that, apply it in your calculation, you'll be able to arrive at what is the pure cash adjusted proxy beta. Now you'll also know, when we do this, we also do one thing. In our calculation, whatever comes through, finally we add the cash component separately as non-operating assets. So this cash, it is only right if we remove the cash in all our comparatives. That is the logic behind this. So you remove the cash in all the betas, you bring back the beta, you calculate the value of that particular asset, and you add your cash separately. So a few adjustments, few ideas that I usually take care. I always use the closing rate when I go ahead and do a calculation for beta. It is not the average rate, it is not the opening rate. Still, it might give you some amount of, it will not make much difference. It will have a very minuscule difference, but still I use closing rates, use daily rates, daily returns, because if you take monthly or yearly or weekly returns, there will be a huge variation. There can be a huge up, there can be a huge down. The closer the number of the periodicity of the data that you're going to take, the more the number of data that you're going to take, the better your results are going to come down to. Financial statements, take it on an annual financial statement, take annual financial statements. And when you take annual financial statement, it will only provide you a guidance. Go ahead, project it and find out the values for the debt equity and the fixed costs. Take the latest financial statement, that will give you the better idea. And also the cash component, you can take the comparative companies' latest financial statements, that will give you the cash component in their total assets. Stock splits and bonus issues, when you are calculating the return, if there is a stock split or a bonus issue, sometimes the indexes only when the companies will only capture the actual value of that particular asset, the actual value that existed on that particular date. They will not factor for stock splits or bonus issues. You'll have to be careful there. You'll have to factor for it. Then noise reduction, any extreme stocks that you find. If say GameStop is going to be there as a technology stock that you're going to try and do a valuation for, it is a comparative company. Don't take that kind of stocks that will skew your result. If you know it as an absolute extreme, leave out those kinds of stock. That will give you a better idea or presentation. Now, alpha, as I told you, I'm going to take you through only one slide of alpha. Alpha is going to be very simple. Alpha is the measure of the asset's unsystematic risk or diversifiable risk. It is an intercept value. We will argue on it, but then my understanding, I'm able to project it here. When you look at the capital asset pricing model, I told you it will only be able to give you the return that the market you can expect from the market. Alpha is the return you should not expect from the market. Alpha is the return that you can expect over and above the market. The market represents the system. The market represents the undiversifiable risk in the system. Instead of me investing money in a diversified market or fully diversified market, the risk is undiversifiable. If instead of investing there, I'm going to invest in a market in a particular asset which can be diversified. Instead of investing here, if I'm going there, instead of going for an undiversification, I'm going for a full diversification. I'm going for an undiversified thing. Treatment. I'll come back to that, sir. So if I do that, then essentially what happens is I'm taking extra risk. But am I doing it on a conscious basis? Yes, I'm doing it on a conscious basis. Instead of investing in the market, I'm coming to a single stock. It is a conscious decision I'm making. So if I want to get compensated for it, if in my own analysis, if I'm going to do a valuation for it, apart from the risk-free rate, apart from beta into RM minus RF, I will want an extra return from this particular stock that represents alpha. This is alpha. This is the unsystematic risk. It is not in the system. It is not the average. It is an unsystematic risk. Can it be diversified? Yes, it can be diversified. That is why we call it unsystematic diversifiable risk. This will be represented as an intercept value. When I did this plot, you might have seen that there is this line, and between the slope of this line represents beta. Yes, go ahead, madam. Madam, your voice is breaking, madam. Can you repeat? Sorry, we are unable to hear you properly, madam.
Please switch off your video and then speak.
Can you please explain it that how should we use this? Critically, practically, would you please explain that how could we use this alpha in our valuation scenario? Because typically we know the formula that is the AR minus I. I'm not talking about the formula. I want to know that how could we use in practical scenario in our valuation cases?
Yes.
How could we treat this alpha in valuation? Practically, how could we use this alpha? Okay. Because generally, what we know is that we use the beta and systematic risk, and we calculate cost of equity and RRS for the systematic risk of that particular company, and that apply the discounting rate depending upon the risk status of that company and so on. But generally, we used to forget this alpha. So, sir, please could you explain that how could we practically implement this alpha in our valuation cases?
Sure. We'll get
Apart
to that.
from this formula,
Yes.
calculation.
Sure.
Can
I'll take you through, madam.
practically.
Yes, I'll take you through that. So now, let me complete this. I'll come back to that. This beta is the slope of this particular characteristic market characteristic line, and the difference, the intercept value of say 5 that we get here, this might be called as your alpha. So this is your alpha here. Okay. Now let me go back to the alpha part. Let me try to explain whatever is something that I probably have read about, something that I've learned about alpha. It is calculated by comparing them again. This is similar to your beta. I've just given it for the sake of understanding. I told you it is the intercept value. When you plot the values, you arrive at the characteristic market line, and then the intercept value, the value that the base value that you cross, that is your alpha. In terms, we expect market return for a given undiversifiable systemic risk. The excess return of the portfolio or the asset or business over and above the market return is called alpha. This is all simple. It is all just the definition. To understand what is alpha, I will give you my understanding. You go ahead and do a fair valuation of a share. When you go ahead and do fair valuation of a share, what happens is we usually take into consideration, we look at the market and only that market return or market, whatever is the risk for this kind of asset we are taking, that is your RF plus beta into RM minus RF. We stop there. But what is alpha? Alpha is the risk that somebody takes. If I want to invest in this kind of stock, what would be the extra risk I am taking? And what should be the return that I should expect for the extra risk that I'm taking? Instead of investing in this stock, if I go to a mutual fund, I'll be able to get, my risk is reduced by a big extent. Why does that happen? Because I am investing not only in, if I am investing in auto sector, I am investing in all the companies in the auto sector. If I am investing in, the market as a whole, instead of investing in ITC, I am investing in all the assets that are there in the FMCG business. So that risk is much lesser. There, the risk is much lesser in comparison to the risk that I'm going to take now. Correct? So for this extra risk, I want an extra return that is represented by alpha. This is an individual oriented return mechanism. It can be any percentage. It is an individual oriented percentage that I can decide. I think I'm taking an extra 1% return. I want an extra return for the risk that I'm taking. In calculation of fair value measurements, when I'm making a fair value calculation of any shares of a company, this alpha will not be coming into play. Why it does not come into play? Because you can expect only what the market can offer. I cannot make an extra judgment that I should be, now because I don't have a say in this particular matter. Two different people are getting are involved in this particular matter. So should we say that alpha is the perceived risk premium over and above the systematic risk? Yes, it is an individually, for me, I am perceiving this amount of risk. Probably if you are able to earn more than the market, then essentially they have done something over and above what they have taken an extra risk than the market, and they are able to make that particular return. If you are expecting 15% return, and if they are able to make 16% return, that 1% is because they have taken an extra risk somewhere. You do not know what kind of risk that they have taken, but the 1% that they have earned extra is the alpha. So in your calculation of fair value, this alpha will not come into play, because in calculation of your fair value, you only compare it with the market return. Correct, madam? Should we understand that alpha has no role in valuation? It has a role. If you look at it from your perspective, an individual person, you want to have an extra return. You're doing a say example, you want to have an extra return from this particular stock because you perceive the risk is higher than the market risk. then go ahead and do the alpha. Unless otherwise that is there, if you are doing a fair value measurement, when you are looking at the common public and doing a valuation, you cannot, for another person, for the common man, if you are doing a valuation, alpha will has no role in doing your valuation. Go ahead, sir.
So, Mr. Santosh, just one thing. So while we are talking about the beta, I think so there was a statistical method also to compute the beta using the natural logarithm and standard deviation. Will you going to touch base that formula also for the understanding?
Yeah, okay, no problem. The
yeah,
slope
please,
formula.
When
Yeah,
whenever,
sure. I'll run it through another
Yeah,
1 or 2
thanks.
minutes. We'll close this session and I will be running through an Excel sheet. I'll just try to simply run through an Excel sheet wherein you can understand where this data is taken from, how it is, a statistical formula is getting calculated.
Yeah, sure.
Go ahead, sir. Pinkesh, sir.
Yeah, thank you. So I think the explanation is pretty comprehensive. Only two things. One, when we look at it from a valuer standpoint and we get an engagement to look at a valuation of a particular shares, which is unlisted, and we have to give a report, the alpha comes and plays an important role in the manner that it needs to be considered apart from the difference or the dissimilarity between our subject company vis-a-vis those peer group which are listed, whether it is on account of margin, size, scale, type of product, or client concentration, illiquidity, control. These are the factors which are generally taken. And if you have with a 1 beta, let's say you have a discount rate of 15% as the cost of equity, over and above the cost of equity, the riskiness needs to be built in. And then you have to use it in your discount rate, or same alpha becomes as a discount premium in your multiple as well. So that is, alpha is very crucial. It depends on the experience of the valuer and the judgment of the valuer, depending on the purpose for which the valuation is called for.
I agree, sir. But one thing is, this can be adjusted inside the beta itself. As I told you, if your stock is fundamentally different from the comparatives that you're taking, base refinement that you're doing in the beta stage, in the calculation of beta stage, you can factor that inside the beta itself and you can close it there. So alpha is over and above that, even over and above the fundamental differences between your product and the products that are available in the market. Over and above that, there is a risk, because inherently that risk is there. If I'm investing in one gold egg, and instead of investing in a basket of eggs, obviously there will be an extra risk. If I perceive it to be an extra risk and if I want a return for it, that is the risk that we are talking about in alpha, not the difference between the base characteristic of my company's product or services to the basket's product or services. The fundamental characteristic difference will also be factored inside the beta itself. The diversification risk that is there, that only forms or constitutes in your beta, I mean alpha.
I think as a
Madam, you switch off your video and then speak.
As an investor, one said rightly that it plays role. So if we compare this AI, okay, my voice is audible now? I think as a valuer, am I audible?
Neelamji, please switch off your video. Yeah.
Hello. Yes, I think as a valuer, this alpha doesn't play any role. But if an investor, this alpha becomes a critical role that we can compare that whether particular stock is overpriced or underpriced, comparing this AR versus RR, means how much actually that company is going to is actually giving the return versus how much it should pay return as per the systematic risk involved in this company. Am I right, sir?
Correct. In fact, portfolio managers use it. They say the total value, when you compare it to the market, Nifty is performing in this manner. My portfolio, when you compare it to the market, should have produced you say 10% or 12%, but I am able to make 14% return for you. The extra 2% return I am able to make over and above what the market is able to make. That 2% is called the alpha.
Sir, do you think it's like if a company in IBC and somebody buying to purchase it, and we are doing valuation for that person, so we can add alpha there for for the risk they are covering for the IBC company, and they want a extra return over it because there is a different kind of risk there.
That's what I'm trying to say, sir. Transaction wise, if you are doing a valuation, if a transaction based for that particular transaction individually, if there is some kind of synergy that is going to be there because I'm buying it, if someone in the market, if he's going to buy it, he will not get that synergy. I know something, I am trying to buy it, I am getting some synergy benefit of it. Because of that, if there is going to be some extra value that is going to be derived, that is alpha. But when you go and do a fair value measurement, fair value valuation, let me try to, yes. When I do this kind of fair valuation, when I'm doing, I cannot do a transaction specific valuation. If Tata Motors is buying Tesla, they will have a better benefit than ITC going and buying Tesla. So there is a synergy that is there. But when you are doing the valuation of Tesla, you cannot take that synergy into effect. You will do the valuation of Tesla in its own individual capacity. But Tata has its own agenda. They will see there is an extra return that can be brought. That is the alpha that they are looking at.
Okay.
So when we as valuers,
I disagree. I am C. Rahul Jain. Yeah, I
another
disagree.
question.
I politely disagree with your view. Sir, Amit, let me close this point first. Sir, when we are doing fair valuation, we look at Habu also. Okay. It's not as it basis. It's actually the highest and best use. And plus fair market value is also a value which can be offered to a company in an open market between two willing buyers and sellers. By definition, you see, when we talk of this thing synergy, if there is something called intrinsic value, so their intrinsic value is perception based. That I agree. If two valuers are valuing the same company, they will have a different perception of intrinsic value. They can see different growth patterns, they can see different discount factors. That's a different view, that's a different matter. But when we are valuing a company, we are valuing it as if we today sold it with Habu, highest and best use method, using highest and best use method, and in an open market. So what a willing buyer or a willing seller, how will they come together, and at what price they can come together? So we are targeting that only. So if we, yes, then that will goodwill in accounting also. If we are paying above fair valuation, if we are paying something more, then that will be goodwill. But that fair valuation is not as a business as a going concern. That fair valuation is individual asset valuation. So that is goodwill. But here we are looking at business as a whole. We are considering business as a going concern as an asset. We are trying to find the intrinsic value of the business. Okay. This is my limited point.
Right, sir. The point is well taken, but I would like to disagree with this point. Let us agree to disagree. This particular Habu, the concept of highest and best use, it is used in the concept of IFRS. It is used in the concept of Ind AS. It is used for a very specific, definite purpose. We cannot use highest and best use always for all the concepts. Highest and best use, yes, we should use it. But when I'm trying to do valuation of Tesla, I cannot expect all the market should always think as if there is going to be a synergy that is going to be there. We will not even know whether that synergy, the word synergy itself is very subjective. We will not even know whether Tata Motors, if they take over Tesla, will there be any synergy at all in the first place? So you will not be able to put a value to that synergetic impact. That alpha cannot be assumed. It cannot be added in a fair valuation. The market cannot assume this synergetic impact, because the market as a whole, it does not have any synergetic impact from you. All they want is dividend. All they want is the bonus. All they want is the return that you are going to give. We should look at only that. But that's okay. That's okay. What you say can be a point of debate. We can. The point is well taken, though.
When we are valuing shares, there is the question of
I am today being hired by Tata Motors to value Tesla for their buying perspective. Okay, so I am doing the valuation. I will give a fair valuation of the company of Tesla as per my valuation methodology, that this is the value, and I will give a band using a range of growth, using a range of discount factors. I will give a band that you can buy in this range. Okay, if tomorrow Tata Motors pays up above upper band that I have given them, Okay, if tomorrow the Tata Motors pay, and if they can see value more than that, then you can call it that the promoters were seeing synergies over and above what valuer can see.
Okay.
This is what my limited point is.
That is okay, sir. That is okay. The valuation report that you gave for Tata Motors is a recommendatory in nature. That report is going to give them how much is the floor price, how much is the cap price, how much is Tata Motors should do that transaction for. But from the valuation as a registered valuer, we are not recommending, but rather we are trying to ascertain in the market what would have been its rate. So this valuation report that we are going to give will not be the buy rate, should not ideally be the transaction rate, but we are going to say, okay, this seems right. So that is where it is. But that's okay. We can agree to disagree here. Let us quickly move. Let me complete 2 more slides. I want to run that Excel sheet, how to create it. We'll connect back on this though. Now, going back to understanding values, these are the 3 points I would like to take you through. So one, I am going to take extra 5 or 10 more minutes for the practical session. So please bear with me. One, all the valuation that you are going to do, when you do the DCF method of valuation, it is going to be the enterprise value. That is the value of the firm all put together. So let us assume for this particular case, for this flow to work, let us say it is the free cash flow from the firm, which is discounted with weighted average cost of capital. That will give you the enterprise value. Now with this enterprise value, the beauty is that the value you have arrived is only from the value has been arrived by taking into account only the assets and liability that are used for the purpose of business, which is operating assets and operating liabilities put together. Whatever value that company is able to make, that is the enterprise value. You'll have to add all the non-operating assets. Tata Motors will have a piece of land somewhere in Coimbatore or somewhere in Gurgaon, which it does not intend to use as factory, also only for investment purposes it is holding. That asset will not be, that asset's value will not be factored. It will not be reflecting in the DCF calculation enterprise value. Add that asset, add that land and building, add the jewelry, add the cash balances. If not for land, jewelry and all, at least the company will have cash balance. Unless otherwise it is a banking company, cash is not an operating asset. Add that separately. This is the reason there in the beta calculation, I told you should factor out in the beta cash outside. This is the reason, because here you're factoring out cash you're separately adding. Then finally, afterwards, whatever value you are getting, this firm value that you are getting, reduce the debt value. Debt value, if you are able to reduce, you'll get the equity value. Now, in the case, if you are using FCFE model, free cash flow for equity, and if you are doing a discounting using the equity return, then KE, then you will be stopping with firm value, no debt value reduction, but this non-operating needs to be separately added. That will be there in the previous one. Now, let me quickly run on to a few doubts I have, and you can try to give me some probably some reasoning to it. I'll quickly run it through, but probably not the answers. Should I add cash as part of the working capital adjustment when I calculate free cash flow? Don't adjust cash as part of your working capital adjustment. It goes again cash flow statement tenets. Might be a simple doubt, but I have seen 2-3 people adding cash as part of current assets when they are working out the free cash flow. When should I include cash and bank as non-operating assets after I do the DCF operations? Yes, cash and bank you'll have to add separately. What is pre-money and post-money valuations in the fair value calculation as per statutory requirement? Should I do pre-money valuation or post-money valuation? Pre-money valuation is before the money being introduced into the company. The investment is going to happen. Before that happened, what is the value? That is pre-money valuation. After the money is introduced, how is the business going to flow? That is post-money valuation. We always use the post-money valuation. Now, quickly, let me run through Let me run through. I will share with you my screen. I will show you the Excel sheet, how to calculate beta. Quickly, let me run through it. Sorry, I'm going to hold you for another 5 more minutes.
Sir, you have said that we always do post-money valuation. But right, to my limited knowledge, we always do pre-money valuation, because the number of shares, what the free cash flow from the firm we get. Okay,
correct.
What free cash flow from the firm we get after discounting that and after doing the operating asset and non-operating asset adjustments, we divide by the number of shares that are existing today. not
Okay.
after post valuation. So we always do pre-money valuation.
Sir,
When we
you
do-
one small doubt. The value that you are arriving at, if say example the company does not run, say example if the company's the number of shares that is going to be there, what is the value of the share that is going to be offered to you is what we are trying to calculate. If it is
Yes.
going to be a transfer, I agree. If it is going to be a transfer of shares, I agree. We'll do the same method. But if it is going to be allotment of shares, do we actually have to do the pre-money valuation? I don't know. Probably we can discuss on this. I thought it is post-money valuation. Probably if it is a pre-money valuation.
No, if we look at post-money valuation also, na, you please try it in your Excel. I have done it. If you have valued on a pre-money basis and you have divided by that equity shares to what you are having today, and if you multiply those equity shares that you are planning to offer or issue tomorrow, so if you multiply by that and you add that numerator and you also add the number of shares in the denominator, you will find the same value then.
Okay.
No. See, the reason why you do pre-money valuation is, let's say I am an investor who, I'll take a couple of minutes. I am an investor who is coming in. Okay. So I'm giving you 100 crores. Now, when you do post-money valuation, the value obviously goes up, right? So what you're doing is, my share, the number of shares I will get is being, it will come down, obviously, because the share price will go up in a post-money scenario. So you're telling me, you're taking money from me and you're investing that and you are increasing the price for me, which is unfair. So typically what you do is you do a pre-money valuation, arrive at the price per share, then you just add the investment that I do. That is a post-money valuation. And like Mr. Rahul Jain said, you do, if it comes to 10% stake, you do the value into 10 by 110, and then you find the number of shares. There'll be a marginal reduction in the number of shares. But from a valuation point of view, you do pre-money only because you can't charge me for the money that I give, right? Today, the value, post-money is 100 crores.
Sir, for
That's
the
correct.
valuation perspective, again, it depends upon the situation. In many situations, we have done the post-money valuation also, where we need to consider the dilutive basis of the equity valuation. So again, it on situation to situation, whether it's a pre or post. So I think so there can't be a single answer, right, Mr. Santosh?
Yeah, I agree to it, sir. I agree to it. My when I look at it, yes, what I probably am looking at things from the post money perspective, but now I understand where the pre money perspective is also coming through. So it is a very dependent thing. If you are looking at certain things, you might have to look at it from a pre money perspective. In certain scenarios, you might have to look at it from a post money perspective. So we probably have to connect back. I might have to revise my slide to this extent. It is not only pre-money, it is not only post-money. I might have to correct it. I'm still in the process of learning. I will learn from you people. Probably in the next slide, we can, next time when we meet, probably I can come out with a better understanding of this particular matter. Now, let me share your screen, share my screen for your, how do I share the entire screen? I don't know. Entire screen. Advanced. Okay, I hope you are able to see my screen now. Okay, now in this screen, I have went to BSE index. I am trying to find out from about 20 years of return from this particular stock. I am not taking the date to perfection. I'm taking a Tata Motors stock. I will be able to get the stock price from 18th of June 2001 till today. I'm going to download it. So I am going to take, as I told you, I'm going to take the closing price of this particular stock. This is in a descending order. I'm going to just make it in the ascending order because the market data comes that way. So this is from Tata Motors. What I try to do is I try to find out what is the return from this particular stock. So these are the daily returns from Tata Motors. Okay, so there is some problem with the numbers. I have, I think I have.
Sir, when you sorted it. When you sorted it, it became wrong.
Yeah,
Smallest to
sorted it
smallest
in
to
the,
highest.
yeah, I sorted in the smallest way. I
You
should
can
have
do
sorted
undo.
it in the date.
Yeah, and now you can correct it.
Okay, so I calculate what is the value return I am getting per day on all these stocks. So this is with regard to, this is return I'm getting. I'm going to name this data. So I'll again download another set, which will be an index, say, let's say NSE 500. Let me go back to the screen. Is it directly coming here? Not coming here. So I'll go back to market data. I'll go to indices, historical prices of indices. Say I'm taking NSE, so this is BSE. So BSE 500 daily data. The one thing is I'll have to be careful here is I'll have to be careful with the taking the same set of data as the stock return. I'm going to take it from 18th till 18th of this date. I'm going to download it. I'm going to take the closing values. So whatever I've done there, I'm going to do a similar thing here. This is the closing values of the index. I'm going to find out the return. The return that I'm getting for the on a daily basis. Now there are two ways of actually calculating the beta. One is finding out covariance and then the variance. Covariance is nothing but covariance.p. There is a formula that is available. Open bracket. Array number 1, which will be in this particular case Tata Motors return. Okay, I should not take the first one. I should start from here. Okay, comma. I should take the next one. And the variance is that of the index. Okay, where from here to here, bracket. I think I've taken it in the reverse order. This should be equal to covariance. This should be the first. This should be the second. Now, this divided by covariance divided by variance gives 1.26. This will be my beta. And the other way of doing it is using the slope formula equal to slope. In slope, I will take the daily values of the known y's, comma, daily values of the x's.
E4.
So either this way you go or the other way you go, you will be able to arrive at the same value. So this is how we calculate beta. I have not made any adjustment, including adjustment for bonus issues. I have not made any adjustments with regard to any other adjustments for that particular matter. This is the basic version of how you calculate beta. You make your adjustments, then you the leverage, non-leverage, cash related adjustments, operating leverage adjustments. If you do, you will be able to arrive at the beta for the proxy beta for using in your valuation purposes. So with this, I will try to close the session for the day. If any doubts are there, please go ahead. Otherwise, we'll close the session for the day. Go ahead, sir.
I have one question related to market return.
Yeah, go ahead.
Which you said that we should go for the market index for future 5 years or whatever the timeline. But with that we have to do a lot of work, and making the client understanding that number would be very difficult, because with the CAGR it is pretty simple with the CFOs and the financial people to make them understand how the calculation is. So is there any, and to get the
I am not saying CAGR you should not take, sir, but history and the future when valuation is always future focused, and when we are taking history as the only base in this particular category, it might be a little difficult to arrive at the right value. That is my argument. I'm saying if I take the past, if I am an emerging country, I started from zero, I came up here, and now I'm not going to make any return. When you compare an emerging country, we can expect more return when you compare it with a developed country. If India suddenly becomes developed, I don't know, 2022, 23, it becomes developed. You are looking at the past 20 years, the emerging markets return, and you are comparing it with the developed countries return. So that is something I'm just worried about.
Okay, another thing, that how to get the data, because let's say we are taking data from Mr. Damodaran side, and whatever if we trying to get the data from Indian perspective, is there anything available which is not let's say not the paid version of Bloomberg or something?
Getting this data is going to be trouble only. So what he is doing the same way we are doing. He is going to do it for the US, and he is adding that country risk premium to arrive at Indian risk premium. So but how does he do it? He looks at the market, he adjusts the future 5 years income. What are the dividends that is going to be? What is the return that the companies are going to provide to this particular to the investors of this particular market? He's trying to arrive at. There is no hard and fast rule. I don't know where this information is available. You'll have to go and find out for if it is S&P 500 or if it is going to be BSE 500. You have to find out the 500 companies individual return. What are the projections that the company is giving for all these 500 companies separately? You'll have to arrive at it, and then you'll have to factor it inside your calculation. It's tough. It is tough. It is, but it's just not impossible.
Okay.
Damodaran is giving so many columns. Now there are so many columns which he says. I have put that question. So can you please answer that in the chat?
With regard to Damodaran's site, let me go to his site. Let me try to see the beta site you are talking about, right?
No, not the beta, the risk part. The country risk and
risk premium we might have to see, sir. Yeah. Probably in beta I can help you out. Risk premium, even I might have to go through this country risk premium. As I told you, how he calculates, it is a little tough. I probably
his terminology also is different. He doesn't simply say country risk and equity risk. He says a lot of things over there.
Correct. Probably we'll connect, sir. We can connect separately and we can discuss on it.
Okay.
Can you just open that Excel sheet? Just 1 second.
Yeah.
Padmaji, hello, how are you?
I'm good, sir. Yeah, could you just place that cursor on that covariance formula and that variance formula? Just, yeah, I'll, 1 second.
It's nothing but covariance of the return from the market, return from the individual share. Yeah.
And variance?
Variance, it is only the market.
Okay.
Instead, you can use the slope formula directly also. Equal to slope, you take the return from the individual stock, the return from the market.
Okay. Thank you.
Okay. So with this, allow me to conclude this particular session. If you have any doubts, you can reach out to me. Probably we can discuss. Probably I have learned a lot from this particular session.
So
my understanding of certain. Yes, go ahead.
It was great, sir.
So just one question is, I need to know, like in case of startups, whenever we are valuing a company and we want to, gather the data for beta. So is it like, can we take the peer companies of the same market or industry, but somehow I feel that, taking the industry beta, of the peer companies, isn't it vague? Isn't it giving us a vague answer towards beta calculation?
You're saying if we are taking the same industry. So can you give me an example? If I'm doing a valuation of a food industry, so it says Zomato, what are you saying?
No, the point is, like, in case of any startup, just for example, if there's a local entrepreneur, right? He wants to, reach out the global market and see, everybody has dreams, so he might want to pursue that. He will be one day he will reach the global market, so at least the pan-India basis, right? So as of now, it's just a startup. So can we take the peer? Do we really need to take the peer companies, data and calculate beta, and then we should come on to his beta? I mean, isn't
I
that
agree.
a bit vague?
It is tough.
Startup has nothing in its own hand. I mean, there's nothing. But we can't even compare that, that initial investment of that company, of that investor, to, such a big company, which is already running and in business from so long. I personally feel that it does give a vague value, and our, calculation and our entire valuation exercise goes wrong. This is what I feel. I mean,
Madam,
I really need a suggestion on it.
Your valuation for any startup is wrong. Ola started, their business model itself went wrong. They started with a business model where they were supposed to fly cars and vehicles from one state to another. But then they pivoted, their business model itself changed. They had to fly cars within the city. So when business models change, your valuations are not going to be same, it is going to be different. So don't worry whether the valuation that you're going to give for startup, is it going to be put on stone and it is going to be held against you? You make a lot of assumptions. When as far as you give all these assumptions in your report, and based on that you provide the you arrive at the value, it's okay. This is point number one. Point number two, it is not necessary for you to find out the betas from similarly placed smaller startup companies to arrive at the beta for comparing to this particular company. You cannot do it. You should not do it. Rather, you should go ahead and find out all types of companies, because this is a relative, beta is a relative factor. You are making a comparison of that particular security system with the broader market. And when you are doing that, anything that is going to be there, small or big, it's going to get cancelled out. And the relative factor is what you're going to factor in. So you don't have to worry there. You can take, if you are going to take a small technology company, if you are, is it okay to compare it with Amazon's beta? Don't compare it only with Amazon beta. Compare it with all the technology companies, big, small, country-wise, whatever is there. If you are able to arrive at 100 technology companies, and if you are able to arrive at a beta, that will be more qualitative. It will be able to give you a better beta.
So going back to this, we can even take a global company's beta as well.
Yeah, you can use global countries beta. You can use Amazon's beta in your calculation.
Kindly share your slides.
One last question.
Yeah, go ahead.
Is there any mention of when to use pre-money valuation or post-money valuation in any valuation standard or some regulatory thing, or is it a discretion of the valuer?
It is not there. It is not provided. Valuation standards, it gives you a very broad idea of what needs to be done. It stands at 20,000 feet level and gives you the idea, but I have not seen it. Probably if it is there, please share.
Kindly share your slides.
Yes, I will definitely share the slides.
Just one question.
Yeah, go ahead.
In case of a merger of company, because of the business model, let's say one company is having negative value, another company has a positive value. How the swap ratio could be determined? Like, if one company is valued on cost approach and it is having a negative value, another company on DCF is having positive value. So how do we derive the swap ratio? In that case, do we assume one of the negative value company, we assume one equity value one, or some negative?
Oh, you're saying the company itself valued at negative?
Yeah, because it has no.
Then there is no swap ratio, sir. You should give the company to the other person and walk away. If the valuation cannot be negative, if the valuation is going to be negative, then there is nothing that is there.
Just give it free.
You should give it for free.
So, sir,
in that particular case, there is a possibility this can occur, but the possibility of two companies engaging in this kind of scenario and trying to negotiate the term will not occur. The other company might be magnanimous enough to absorb their liability. They can say, okay, I can make something good out of this company. I will absorb it. But only thing is, I am going to allow you to go scot-free. That is probably the end of it.
So
that is zero value. We should assume zero value.
You should allot zero value for it. Yeah, go ahead.
That generally happen in case of this holding and subsidiaries merger, where the negative subsidiaries value is there. And sir, when you are saying just one share, so I have seen my practical case where the lawyer, while filing the merger application, they have mentioned on a nominal basis 1 share can be given. But as a valuer, we have assigned a zero value.
Agreed. I agree, sir. We as valuers, if we find out there is no future income, there is no income that is going to come into this particular company in the future. There is no the assets minus liabilities gives you a negative value. We should always give it a zero value.
Okay.
Nothing
So
wrong.
the Barings Bank transaction was like that. Barings Bank, $1 token. Even I think Anagram Finance, when it got merged into ICICI Bank, one golden share or one simple share. Similar
That one
examples
share,
are
no,
possible.
sir. When we are saying one share that is being given, it is a very customary for the customary purpose. Point number one. Point number two, it is more like me giving, when I have 199.05 as the valuation, I round it off to 199. So
Absolutely.
that 0.05 rounding off, we can say.
Absolutely. It's nothing to do with value or the negative. It's a token given for the.
Correct.
Yeah.
I agree. Any other questions, sir?
It is not called golden share, sir. It is just one share. Golden share has a different meaning. Golden
No,
share.
fine. We are not getting into the nomenclature of it. I'm just saying because for
just
them they kept it as a golden share.
No. Golden share by definition means that you have special voting rights on the share. Say, for example,
I don't want to get into this technical matter.
I was just clarifying that the term golden share is used differently. When Maruti, government sold all its stake to Maruti, government was allowed to hold a golden share by which they had a veto on certain,
That's called veto
matters.
share.
So
Veto share.
that is called a
veto
golden
share.
Okay, thank you so much.
Thanks,
for attending this session. We'll close the session for the day.
Thank you so much.
You. Good day.
Okay, so we are coming to our end of this session. Thank you, everyone. Thank you, Santoshi, for preparing this subject very nicely. You had to work really hard, I know, but you have done justice. And I hope all participants would have benefited. Thank you, participants, for participating in this program. I look forward to your association in future also. Thank you, everyone. Thank you very much.
Thank you.
Thank you. Thank you very much.
Thank you, sir.